Welcome to the Daily Consolidation, your essential daily briefing on Wall Street's most important moves, bringing you the market insights that matter, delivered right after the closing bell. Please note the views and trade ideas shared on this podcast are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
Okay, so after all that sustained panic and the credit stress we saw last week, Monday really felt different, maybe like a tentative pivot.
Definitely a different feel.
We saw the S&P 500 close up 0.53%, hitting 6,664.01. But, earlier in the day, we were actually up quite a bit more.
Yeah, about 1.9% at the peak, wasn't it?
It was. So on the surface, yeah, it looks like a risk-on rally. But the big question is this real conviction, or is it just a kind of technical relief bounce?
Well, I think the immediate clue isn't really in the price itself, but maybe in the fear gauge.
Yeah.
The VIX.
Yeah, volatility. Exactly. It plunged today a massive 17.90%, dropping down to 20.78.
Wow, okay.
That's a really clear signal that the outright panic has definitely dissipated. It pulled sentiment off the floor.
Right.
But the real story today isn't just the rally itself, it's why the market decided to rally now, and maybe more importantly, are sophisticated investors actually buying into this?
Okay, good point. So let's try and unpack this pivot then. The immediate reason for this tentative shift back towards risk-on seems to be mainly geopolitical, right? We're talking about those easing U.S.-China trade tensions.
That narrative, yeah. It definitely provided the necessary cover, let's say, for fund managers to start re-engaging with risk assets again.
And you saw that in the rotation.
Oh, completely. The rotation was textbook, cyclical, small caps. They absolutely outperformed. Just look at the Russell 2000.
Led the charge, yeah.
It really did, climbing 1.95%. That tells you pretty clearly the flow is moving out of defensives and into assets that are most leveraged to, well, economic growth and trade stability.
And we saw that ripple into commodities almost immediately, too. Soybeans, for instance, always super sensitive to Chinese demand.
Up almost 1%, 0.94%.
Yeah, and even the more speculative assets got a lift. Bitcoin, for example.
Right. Confirming that return of maybe speculative flows, it surged, 2.54%?
Managed to reclaim that $110,000 level, too.
It's just fascinating, though, how quickly the market is willing to bid up risk based purely on the hope of a trade deal.
But that hope, it has a deadline, doesn't it?
It absolutely does. A massive expiration date. We've got those critical talks scheduled in Malaysia this week.
And the November 10th truce deadline is just looming.
Exactly. So the instant those talks maybe break down or even just falter, this whole reversal could end, well, violently. Feels like a pretty fragile rally, built mostly on headline momentum right now.
Speaking of volatile headline momentum, we saw a huge surge in the industrial materials sector today, also tied to another angle of that U.S.-China geopolitical tension. Critical materials.
That's right. Cleveland Cliffs, ticker CLF.
Exploded today.
Just exploded, yeah. Surged a massive 24.5%. And this was after their CEO announced potential, and I really have to stress potential, rare earth discoveries.
In Michigan and Minnesota, right?
In their mining sites there, yeah.
Okay, a 24.5% jump is just huge. Why is this more than just, one company's potentially good news?
Well, it connects directly to this intensifying challenge for the U.S., the reliance issue. Rare earths, they're essential for, modern defense tech, EVs, everything.
And China just tightened controls.
Exactly. China announced strict export controls on these materials earlier this month. That provoked tariff threats from Washington almost immediately. So the market now is pricing in any hope, even speculative hope like this, of domesticating that critical supply chain.
And I guess if you needed proof that this is, a significant trend people are investing in, you just look at the peers.
Absolutely. Look at MP Materials, Trilogy Metals.
Yeah.
Two major rare earth players.
Their year-to-date performance is staggering.
It really is. Up over 420% and 480% respectively. So this CLF news, it just poured massive amounts of speculative capital into what was already a pretty overheated theme.
Okay. It definitely shows where the speculative money is flowing. But this kind of brings us to the core tension of the day, doesn't it?
It does.
If the market is supposedly so optimistic about trade and risk assets, why are we seeing such, profound contradictions elsewhere in the market?
That's the key question, the sort of split personality in the market today.
For me, the biggest red flag today was gold.
Ah, yes.
We saw gold surge 2.32%, hitting $4,348.80 an ounce. Now, gold is typically a safe haven. It usually sells off when trade optimism comes back. So what does it signal when gold and equities are both rallying strongly together?
Well, it seems gold is actively, almost forcefully, rejecting that risk-on narrative.
Hmm.
This tells you investors aren't just buying trade optimism, they're hedging their bets. They're maintaining this deep-seated protection against inflation, or maybe more crucially, monetary debasement.
And it's not just today's move either.
No, not at all. Gold isn't just up today. It's up, what, 16.05% in the last month alone?
And year over year.
Staggering. 59.80% compared to this time last year.
Wow. Nearly 60% year-over-year climb. That tells us institutional investors are fundamentally pricing in some deep structural fear, regardless of today's sort of momentary hope on the equity side.
Precisely. And if you connect this to the bigger picture, it points directly at the Federal Reserve.
The upcoming meeting.
Rate cut expectations for that October 28-29 meeting, they remain near certain. Still sitting around 95% priced in for a cut.
Okay.
That just fuels the narrative that the Fed will continue monetary easing,
Right.
ensuring ongoing debasement, which in turn makes gold the ultimate store of value look irresistible to many.
That sentiment also kind of feeds back into our earlier volatility check, doesn't it? While the VIX did plunge nearly 18%.
Which is huge.
It is huge, but that absolute level, 20.78, it's still pretty elevated. If this rally reflected, true calm, we'd expect to be down in the sub-15 VIX range, surely.
Exactly right. The VIX staying above 20 implies that while the immediate raw panic is gone, institutional investors are still demanding a pretty significant premium for near-term protection.
So they're still buying puts.
It confirms professional money managers are maintaining robust hedges. Despite the stock market's bounce today, they're just not convinced this risk-on moment is going to last.
And then there's the bond market. It seemed completely uninterested in celebrating the equity surge today.
Yeah, that was noticeable.
Treasury yields were largely unchanged. The 10-year yield just held steady around 4.01%. Now, typically, on a risk-on day like this, you'd see bonds sell off, yields spike up. Why was the bond market so skeptical that this rally reflects genuine economic durability?
Well, this raises a really critical question about the sustainability of the recovery itself, doesn't it? The bond market appears thoroughly unconvinced that today's optimism reflects, durable economic acceleration.
So what are they thinking?
They might be pricing in the fact that the Fed will have to cut rates regardless of economic strength. Or perhaps they simply doubt the staying power of any potential trade truce. Either way, that lack of participation from fixed income is a major disconnect, a real puzzle piece that doesn't fit the risk-on picture.
Okay, so if the VIX is sort of screaming hedge, while the S&P is screaming buy the trade dip, how do we translate that conflict into, actionable insights? Let's look at the conviction calls coming out of our analysis today.
Okay. We've synthesized the data into 5 sort of tactical positions, but maybe let's focus on the 2 highest conviction ones and also the most potentially volatile.
Sounds good.
My highest conviction call, it remains buy gold on dips. I'd rate that a 5 out of 5 conviction.
Still very bullish on gold.
Yes. The fundamental repricing, fueled by that expected Fed cut and, frankly, ongoing fiscal concerns, just makes any pullback, say, towards the $4,250, $4,300 zone look like a buying opportunity, targeting maybe $4,500 to $4,600 next.
Okay. And the other high conviction call, it sounds like the classic fade the hype play, directed squarely at that speculative momentum we talked about earlier.
Exactly. We rate fade the Cleveland Cliffs rare earth hype a 4 out of 5 conviction.
Why fade it after such a huge pop?
Well, that's just it. While the 24.5% surge is incredibly attention-grabbing, investors really must look at the fundamentals underneath. The company recently reported a net loss and a revenue miss.
Right.
This news about a potential rare earth discovery, it's pure speculation right now. And the timeline for any actual extraction, if it happens, is years away. This stock surge feels like a cautionary tale buying into headline momentum without that underlying fundamental support.
Okay, so those are the top 2. We also maintain 3 other tactical positions that seem necessary for navigating this kind of conflicting environment.
That's right. We still think selling volatility makes sense, maybe targeting the VIX down towards the 16-18 range as the immediate panic continues to fade.
Staying long Bitcoin.
Yes, if it can decisively hold a break above $113,500, that's the key level.
And finally, underweighting regional banks.
Still underweight regional banks. Because despite today's bounce in that sector, the underlying credit problems, we think, are a persistent structural risk that hasn't gone away.
And that cautious positioning seems vital, especially given the calendar ahead. It looks stacked with high-impact events.
It really is.
The critical risks just for this week include, number one, a breakdown of those Malaysia trade talks. We put that at about a 25% probability, but the market impact would be severe.
Absolutely.
And number two, the ongoing threat of, additional regional bank credit announcements popping up. That carries maybe a 35% probability. And we get an immediate test of that sector's health tonight, actually. Zion's Vancorp earnings are due after the bell.
Yeah, that'll be closely watched. But looking slightly further out, the two biggest near-term events you really must track are Friday's September CPI data.
Critical for the Fed path.
Absolutely critical. And then, of course, next week's October 28-29 FOMC meeting. Given that a 25 basis point cut is already 95% priced in, any deviation from that expectation, or even just the commentary around it, will likely generate massive volatility.
And we can't forget the sheer amount of earnings risk coming up, too. Those key mega-cap techs.
The Magnificent Seven, or most of them.
Right. Alphabet, Meta, Microsoft, Amazon, Apple, they're all reporting over the next 2 weeks. Their valuations are so high, any disappointment will just be magnified and could easily pull the broader indices down and fast.
So you put all this together. What does it mean for the overall outlook? I think today felt like relief. It was fueled by hope. It definitely wasn't conviction.
Yeah, I agree.
The market feels like it's truly at an inflection point, balanced very precariously between that trade optimism on one side and these deep-seated structural worries about credit and the Fed on the other.
So our analysis points towards the base case scenario as probably the most likely path forward, although reflecting that intense uncertainty, we only assign about a 25% probability.
Right. And that base case calls for choppy consolidation. We see the S&P 500 trading in a wide, probably quite volatile range, maybe between 6,400 and 6,800 for a while.
Which implies a certain positioning strategy.
Exactly. Prudent positioning, we think, means remaining overweight gold, maintaining a broadly neutral stance on equities, being very selective there, and definitely staying underweight regional banks until we get much more clarity on those three major fronts: trade, credit, and the Fed's ultimate trajectory.
Okay. And maybe a final thought here. Building on those structural risks that gold seems to be pricing in so aggressively, you really need to be thinking about the long-term pressure building on the fixed income side.
The long end of the curve.
Specifically, that building term premium in the long end of the Treasury curve.
Yeah, that premium.
It's a direct result of these underlying fiscal sustainability concerns, right?
Mm-hmm.
Worries about long-term government debt. And that fundamental worry, that deep concern about long-term debt, could eventually act as a cap, or at least put pressure on current equity valuations, regardless of how optimistic those trade talks in Malaysia might feel in the short run.
It's like the debt anchor, isn't it? It ultimately defines the market ceiling, potentially.
That's a good way to put it. That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.